The year is 2006. The economy is booming in the US. The S&P 500 is nearing its all-time high. House prices are soaring and everyone is able to get a mortgage. Both institutional and retail investors are very bullish. However, this chart signals that it's not going to last. The number of corporate bankruptcies spike up dramatically in a few months. Do investors pay enough attention to the cracks opening up in the US economy, as indicated by many leading indicators? Of course they don't. The number of bankruptcies rises by 60% in a year, yet most investors are too greedy to notice it. Was this the only indicator signaling a major crack in the economy? No, there were many of those. However, investors either didn't pay attention to these indicators, or perhaps they said, "This time is different," the most dangerous four words in the field of investment. Hi everyone, my name is Ruben, and today we will look at various business leading indicators that hint to us that serious cracks are opening up in the US economy. Whatever you do in your life, a recession will somehow affect you, be it financially or in another way. So this is a video you cannot afford to miss. We have covered the household leading indicators in part 1 of the series, which you can find in the description of this video. In part 2, we will concentrate on the business indicators, which have a high success rate of predicting economic downturns of the past. Let's get started. Here is the chart that we saw in the opening scene of this video. It shows the number of companies filing for a bankruptcy in the US. In the last 4 decades, this indicator trended downward. However, for the first time since the great financial crisis, it spiked up in 2022, and it's now close to a 100% increase from the lows of 2021. Bankruptcy filings went up significantly during and prior to recessions. The COVID recession is evidently the exception here. It's worth noting that this chart had only a few periods when it went up sustainably. 4 of those increases happened to end up in recessions. However, like any economic indicator, this one is not perfect, and sometimes there are false signals. That's why it's prudent to explore many charts and examine additional indicators in conjunction with this one. And that's what we are going to do in this series. The other 3 spikes in bankruptcy filings were false signals, hence they are false positives, or the type 1 error for this indicator. To put it simply, a true positive means that the indicator signaled a recession and it materialized, and a false positive means that it signaled a recession but it was a false signal. Based on that, we had 4 correct predictions, meaning 4 true positives, and 3 false signals, meaning 3 false positives. Another error happened before the COVID recession. This indicator failed to signal a recession which actually materialized. Although the pandemic recession was unique in its type, at the end of the day it was a recession, and we should not exclude it when discussing the accuracy of various leading indicators. As the bankruptcy filings went sideways, or rather they went down before the COVID recession, this is an instance of a false negative, meaning the indicator failed to signal a recession which then materialized. Thus, in our small number of observations, we have 4 true positives, 3 false positives, and 1 instance of a false negative. When it comes to true negatives, we cannot calculate their frequency, as it would mean the instances when this indicator signaled that there would be no recession and it was a true prediction. To reiterate, this indicator can only predict recessions. It cannot signal that there would be no recession. Or if it did, the result would be infinitely many instances of true negatives. As we have the inputs, we can now utilize a few useful statistical measures to calculate the performance of this indicator over the last 45 years. We will use precision, recall, and F1 score for that matter. Precision is the number of true positives divided by all positive predictions. In this context, positive means a predicted recession. So we get a precision of 57%, which is not that impressive. It means that this indicator predicted a recession 7 times, and only 4 of those were correct. Then we compute the recall of bankruptcy filings, which is calculated by dividing the number of true positives by the sum of true positives and false negatives. The result is 4 over 5 or 80%, which is more impressive than the precision measure. The interpretation of this result is that there were 5 recessions in the last 45 years, and this indicator correctly predicted 4 of those. The exception was the pandemic recession. As we have the precision and the recall, we can now compute the F1 score for bankruptcy filings, which is the harmonic mean of the precision and recall and is viewed as the appropriate overall performance metric. The result is 67%, which is not very impressive, however, it is not very bad too. The problem with this type of statistical analysis and utilizing precision, recall, and F1 score is that we have only a few data observations. However, we should remind ourselves that recessions do not occur frequently, and we will never have enough observations. So it is a limitation of this analysis that cannot be improved. Therefore, we should take this analysis with a pinch of salt. Thus, the 90% increase in bankruptcy filings over the last 2 years is very significant, and we should keep our eye on this data. The next business leading indicator is the Purchasing Managers Index, PMI, surveyed and published by the Institute for Supply Management. Before we move on, let's see what PMI is and how it is calculated. In a nutshell, the Purchasing Managers Index is a leading indicator of overall economic activity in the US that measures the prevailing direction of the economic trends in manufacturing. It's calculated via the following formula, where P1, P2, and P3 are the percentages of answers reporting an improvement, no change, and a deterioration respectively. The outcome of this survey is an index that is bounded between 0 and 100, and 50 is the baseline, meaning a neutral index. As can be seen, the PMI index has deteriorated significantly during and before every recession since 1947. And again, the only exception is the pandemic recession of 2020. The level which differentiates recessions from no recessions can be drawn, and its level is close to 47. During all recessions since 1947, the PMI index went below this level, except for the pandemic recession. For this indicator as well, we can use statistical metrics to measure its performance. Compared to bankruptcy filings, we have more data observations for this chart. There are 11 true positives and 1 false negative for this period. Now let's have a look at false positives, meaning instances when the PMI index went below or close to 47, but a recession didn't follow. There were 5 such instances. However, the PMI index was below 47 in 2022. But we will not count it in our analysis as we are yet to see whether a recession materializes or not for the current business cycle. In other words, it could be either a true positive or a false positive, but we don't know it as of now. Then we can compute the performance measures of the PMI index as a predictor for recessions. The precision is 68.75%, meaning that when the PMI index reached or went below 47, 11 times out of 16 a recession followed. The recall is 91.7%, which is very impressive. It can be interpreted as predicting 11 out of 12 recessions since 1947 correctly. The overall performance measure, the F1 score, is about 79%, which is quite high. Again, we should take these metrics with a pinch of salt as we are limited to a few data points. However, for what it's worth, the PMI index has relatively good overall performance measures, and it should not be overlooked by investors when it comes to predicting an economic downturn. The PMI index plummeted from 65 in 2021 to 47 in 2022. However, after its rebound, it's currently sitting close to 48. So, it is not far from the key zone of 47, and we should wait to see how this chart develops going forward. The next indicator in our list is the year-over-year growth rate of commercial real estate prices in the US. Unfortunately, the chart only backs to 2004, and we don't have many observations to compare the current situation with. The growth rate of commercial real estate started to deteriorate in 2006, and this was another early signal that cracks were opening up in the US economy, namely the housing sector. However, only a few paid attention to it. In the following years, it went as low as negative 29% year-over-year rate, which once again shows how terrible the great financial crisis was. However, the growth rate of commercial real estate prices stabilized over the next year and stayed like that for more than a decade. There were three instances when the rate went almost or slightly negative. However, it bounced off the negative territory in a few months. After the pandemic recession, when the Federal Reserve had the largest quantitative easing round in US history, the growth rate of commercial real estate prices spiked up and topped at around 16%. However, since 2021, it has plummeted and now is in the vicinity of negative 8%. This is significant because it is the first time since the great financial crisis that the growth rate of commercial real estate prices went this low. One of the primary reasons is that the demand for commercial real estate, namely offices, went down drastically as many companies adopted the work from home standard. Thus, the growth rate of commercial real estate prices is in a very low territory, and it should not be overlooked as many banks have high exposure to this underperforming sector. And speaking of banks, let's draw our attention to their unrealized losses on investment securities. When you remember that banks are very interconnected and the whole sector could be affected significantly due to the domino effect, this chart becomes arguably the most bearish one when it comes to business indicators. The losses or gains prior to 2021 pale in comparison with the current levels of unrealized losses. The shares of held to maturity and available for sale securities are about equal. But how banks were able to generate so much unrealized losses? The primary contributor was the sharp increase in bond yields that started in the first quarter of 2022, the same time when the Fed started its rate hiking cycle. You might probably remember that after the largest quantitative easing round in the history of US, Jerome Powell said that the inflation was going to be transitory and that the Fed would easily combat it. Of course, that was not the case. How can the M2 money supply increase by 40% in 2 years without producing a high inflation rate? Coming back to banks, a lot of them believed in Powell and made the rookie mistake of overbuying US treasuries with the abundant cash that was freshly injected after the pandemic recession. Here is the interesting part of the story. The yields on US treasuries were at historically low levels in 2020 and 2021. As you might know, bond prices and yields move in opposite directions, meaning that if yields increase, prices should go down and vice versa. In early 2022, the Federal Reserve started its rate hiking cycle, and it was evident that the inflation was not transitory. As a result, the yields went up significantly and prices of bonds plummeted, the same bonds that a lot of banks overbought. Hence, they now have huge unrealized losses on their balance sheets and are at a greater risk of bank runs. And speaking of the increased risk of bank runs, the Federal Reserve created the Bank Term Funding Program in March of 2023 in order to alleviate the situation for banks at greater risk. It all started when the Silicon Valley Bank went under on March 10 last year, breaking the streak of 800 days of no bank collapse in the US. After only 2 days, the Signature Bank followed suit. A few weeks later, the First Republic Bank fell victim to a bank run. It seemed that another banking crisis was unfolding in the US. However, the Fed was very quick and efficient to respond to this contagion. They started an emergency lending program called BTFP, according to which banks and other depository institutions could get loans of up to 1 year in length by pledging collateral eligible for purchase by the Fed in open market operations. To put it simply, banks provide bonds as collateral and receive zero interest loans of up to 1 year. But instead of being valued at secondary market prices, bonds are valued at par. However, the interest rate for term advances was the 1 year overnight index swap rate plus 10 basis points, and the rates were fixed on the day when the advance was made. The BTFP provided much needed liquidity to banks that had huge unrealized losses and were at a greater risk of experiencing a bank run. It ceased extending new loans on March 11 of this year, and as of that date, the total amount of loans amounted to $170 billion. It's not clear whether the recent drop in yields alleviated the situation for banks, but what is clear is that banks still have huge unrealized positions, and any bad news or rumors can trigger another bank run contagion. It's not only banks that face dire conditions as of late. Firms find it difficult to get commercial and industrial loans. This is not specific to this business cycle. As can be seen, the percentage of domestic banks tightening standards for commercial and industrial loans to small firms increased dramatically prior to the last 3 recessions in the US. When the Federal Reserve increases the short-term interest rate and starts a quantitative tightening round, banks intuitively become hesitant to give commercial and industrial loans to firms as there is a higher risk of default. This chart increased substantially in 2022, however, it retraced from 50 to 20% as of late. Make no mistake, this doesn't mean that it will go back to normal levels. It is still elevated and it seems to be on the rise again. And it's not specific to small firms only. It turns out that middle and large firms face the same difficulty too. The charts for small, medium, and large firms are almost identical, meaning that firm size doesn't matter for banks when it comes to loan tightening standards. Next is the Business Optimism Index provided by the National Federation of Independent Business. Similar to the other charts, this chart too went significantly bearish before recessions. However, there were 3 instances: the recession in 1981, the dot-com crash, and the pandemic recession, when this optimism index didn't go as low as in the other cases. These are the false negatives of this chart. Similarly, there were false positives too, meaning the optimism level went too low, but a recession didn't materialize. That happened in 1992 and in 2013. The NFIB Business Optimism Index fell from 103 in 2021 to 92 in 2024. However, it went as low as 88 in Q4 of 2023. Therefore, it signals that business optimism is at a historically low level, and whenever this index went this low, a recession followed in the last 5 decades. And the last business indicator that we will cover today is the ISM New York Business Conditions Index. The Institute for Supply Management has stopped providing this chart since late 2021. So the data that we see here is up until that time. Logically, business conditions deteriorate during and before recessions. According to this chart, the business conditions were as harsh in 2021 as during the dot-com crash and the Great Financial Crisis. And chances are high that if the ISM continued to provide data on this index, it would be much worse in 2024. Certainly, it would not be better than 2021. In sum then, there are plenty of leading business indicators suggesting that a recession could materialize in 2024. Perhaps, according to some indicators that we covered today, a recession is not only possible, but likely. With all that said, it's needless to remind that those who are well positioned will sow the seeds if or when a recession comes to fruition. Thank you for tuning in. Please like the video and subscribe to the channel so that you don't miss the next part. Have a great day and I'll see you next time.